Hi, it's Adam Hewison. I'm coming to you from the digital studios of Market Club. It's good to be back in Maryland and in our home office, our corporate offices. And today we're going to be looking at the S&P 500 index. And that index, just to show you the symbol for that index on Market Club is INX. And what we're looking at is a chart going back to the 31st of December 2007 through today, September 17th. And what I want to show you today is why buy and hold does not work anymore. The world has changed and you must be flexible. Now if you look at this chart, you can see that obviously the highs were made at the beginning of the year, and then we had a pretty substantial decline through to December. This is December right here, and then as we go into 2009 right here, we actually made a further low, and then we've had a pretty remarkable recovery here in 2009. Now the question is, if you had bought it here or just held on to it, or had you used our trade triangles, would you come out ahead? And that's what I want to share with you today. So let's just take everything off the screen and let's put our trade triangles in, which is very simple to do. We just put our monthly trade triangles in, which is basically the major trend indicator for us. Okay, so the trend indicators are in here. So here's the first one, basically saying trend is down, trend turns up, turns down again, remains down until this point here, at which time it turns up and catches this move. Now at the close of business on the 31st of December 2007, the market closed, I'm going to put the numbers right down here, 1,468.36. Okay. It closed out on December 31st of 08 at 903. Okay, so you can just see that was a loss of 565.36 points. Or if we just look at this in percentage terms, the market was off basically 39% for the year. Now how would you like to have an investment that was down 39% for the year? Even though you had a rally, it would have been worse had it closed down here, but even though you had a rally, it still closed down 39% for the year. Not a good thing. Now say you're still holding it, so you're long from this level here, 903, and the market's trading right around 1066, 1064. So you would have made, obviously, a buy and hold strategy, you would have made plus 18% on the year. Nice, very nice. But the question is, you would have suffered a 39% decline. You're still down from 2007. Not a good thing to be as an investor. Now, what would happen if you used our trade triangles? I'm going to show you exactly how we do this. So let me take everything off the screen. Just remember these points. 39% you would have lost. That's a negative number. And you would have made 18% in 2009 because of the rally. Okay, so if we take everything off the screen, we have our monthly triangles in here, so we know we caught the move down here, and the question is, do you get out of the market totally or do you go short? It depends on you, but the reality is, even if you're out of the market, you're still not losing money on this down move. So I'm going to put in our weekly triangles. As you can see, we use our, I'm going to put this down for you, we keep saying this, but this is exactly how it works. Our monthly triangles are for trend. Okay, the weekly triangles, like here, for timing. So how does that work? Well, if you have a monthly signal, and I'll take the weeklies off, just the monthlies right here. So you would have got short here, you would have covered that position, you would have got short again on the weeklies, because it's in the direction of the major trend. You would have covered that position here. You would have got back in here. You would have covered the position here. And then you would have reversed. This particular triangle, a green triangle, a monthly green triangle, was a reversal. So there you have it. Pretty simple. So let's just take everything off the screen and let's look at the difference. Okay? Let's look at a buy and hold 2008. Okay? We know that was a loss of 39% of your capital. Okay? Now a trade triangle approach, that's TT, you would have made, and this is where the difference is, you would have made plus 26% for the year. So look at the difference. You would have lost here 39% with just a buy and hold, but with a trade triangle approach, which is much more positive, you would have made, that's a positive return on investment. So you've made $26,000 on a $100,000 investment, or you would have lost $39,000 on $100,000. Okay. You can argue the fact that, okay, the market was down, blah, blah, blah. So how do we do in buy and hold in 2009? The market went up, right? Okay, so that's positive. Buy and hold in 2009, you would have been plus 18%. Great, okay? But with the trade triangles, you would have been plus 24.97%. That's a plus, okay? So we even performed the market on the, outperformed the market, I should say, on the upside using our trade triangles. They're very simple, very easy to use, and believe me, as we go into 2010, 2011, 2012, these are not going to be buy and hold markets anymore. You are going to be in trading markets, and that's why the trade triangles can help you enormously stay ahead of the crowd. I don't know where we're standing now, if we're going to have another big downturn or if we're going to keep going up, but I do know one thing and feel confident in saying this to you. I believe that the trade triangles will outperform over time a buy and hold strategy. This is where you can protect your capital by using the trade triangles to be a positive return in 2008 as opposed to a negative return of 39%. You would have been positive 26%, and also in what is turning out to be a good year for traders on the upside, instead of 18%, you could have outperformed that and made 24% difference. It's a heck of a difference. So instead of making 18% and still being down 21% from 2008, the beginning of 2008, you would actually be up almost 50%. Now, isn't that the kind of returns you want to have as an investor? If it is, then I suggest you check out our trade triangles. They're right here. They're easy to use. We've got lots of tutorials. If you're a member, you should be looking at this for the future to lock in profits. Hey, this is Adam Hewison. It's great to be back in the studio talking to you about the markets. I love the markets, and I think you do too. So enjoy. If you have any questions, you can give our tech support team a call. And certainly, if you're not a member, you should become a member. This is Adam Hewison from Market Club. Thanks for watching.